You know what's terrifying? Finding out at 71 years old that the retirement plan you spent 40 years building is actually a trap that's about to spring shut. I just came from my CPA's office. I've been going to him for 15 years. Gerald Morrison. He's not the kind of guy who panics. He's the guy who talks you down when you're panicking. Vietnam vet, been doing taxes since 1979, seen every market crash, every recession, every financial crisis. Nothing rattles him. Today, Gerald was rattled. He sat me down in his office and he had this look on his face I'd never seen before. Not concern, not worry, something closer to anger mixed with resignation. And he said, I need to show you something in Trump's new tax law that's going to financially destroy most retirees in this country. And we have maybe 6 months to do something about it before it's too late. 6 months. He pulled out a document, 547 pages, the Fiscal Responsibility and Retirement Security Act of 2024, passed in December. Nobody talked about it much because it was bundled with the debt ceiling deal and everyone was focused on the government not shutting down. But buried in this bill, on page 847, section 4.1.6, subsection C, there's a provision that Gerald says is the most aggressive wealth transfer from retirees to the federal government he's seen in his 45-year career. Here's the part that should make you sick. You know how they told us to put money in 401ks and IRAs? How for the last 40 years, the financial services industry, the government, everyone told us to defer taxes until retirement when we'd supposedly be in a lower bracket. That was the deal, right? Put money in pre-tax, let it grow. Pay taxes later when you're not working and you're in the 12% or 15% bracket instead of the 25% or 28% bracket you were in while working. Well, the new law changed the deal, and they didn't send you a letter. They didn't hold a press conference. They just changed it. There's now something called the Required Minimum Distribution Acceleration Clause. I know, sounds boring. Sounds like legislative jargon you can skip. Except what it means in plain English is this. If you have retirement savings over a certain threshold, the government is going to force you to withdraw a massive amount starting in 2026, and those withdrawals are taxed as ordinary income at rates that can hit 40% when you factor in state taxes. The threshold, $500,000 in combined tax-deferred retirement accounts. That's 401ks. Traditional IRAs, 403bs, all of it added together. If you and your spouse have more than $500,000 total sitting in those accounts, you're in the crosshairs. And before you think, well, I don't have that much, so I'm safe, let me tell you something. If you've been saving consistently for 30 or 40 years, if you've been doing what they told you to do, maxing out your contributions, letting it compound, you probably have more than you think. I thought I had maybe $800,000. Turns out when Gerald added everything up, all the accounts, all the old 401ks I'd rolled over, I'm sitting at $1.2 million. Sounds great, right? Sounds like I did everything right and I'm set for a comfortable retirement. Except under this new law, I'm about to get destroyed. Let me show you the math, because the math is what made Gerald's face do that thing. Under the old rules, required minimum distributions didn't start until you were 73, and the formula was designed to spread your withdrawals out over your expected lifespan. So if you had $1 million at 73, you'd be required to take out maybe $40,000 the first year, then a bit more each year as the calculation adjusted. The goal was to empty the account slowly over 20 or 30 years while you lived off it. Under the new law, if you're over 65 and you have more than $500,000 in tax-deferred accounts, you're going to be required to withdraw much larger amounts much faster. The formula changed. Instead of spreading it over your lifetime, they're spreading it over 10 years, starting in 2026. Let me make this concrete. I'm 71. I have $1.2 million in my IRA. Under the old rules, when I hit 73 in 2 years, I'd be taking out maybe $50,000 a year. Manageable. Keeps me in a reasonable tax bracket. Under the new rules, Starting in 2026, when I'm 72, I'll be required to take out $120,000 a year for 10 years straight. $120,000 every year, whether I need it or not. Now, you might be thinking, so what? That's your money anyway. You were going to take it out eventually. But here's what happens when you're forced to take out $120,000 a year when you don't need it. I get Social Security, about $35,000 a year. I have a small pension from my years at the utility company, about $28,000 a year. So right there, before I touch my IRA, I'm at $63,000 in income. I'm comfortable, I don't need more. But now add the forced $120,000 withdrawal. My adjusted gross income is suddenly $183,000. And at that income level, I'm not in the 12% or 15% bracket they promised me I'd be in during retirement. I'm in the 32% federal bracket. Add my state taxes at 6%. I'm at 38%. 38% of $120,000 is $45,600 in taxes every single year on money I don't even need. Money I was planning to let grow and maybe leave to my kids. Over 10 years, that's $456,000 going to taxes, almost $500,000, and that's just the tax hit. That doesn't count the opportunity cost of that money not being invested anymore. Gerald ran a calculation. If I'd left that money in the account growing at a conservative 6% annually, over the next 20 years, it would have grown to over $3 million. Under the forced distribution plan, after taxes and loss of growth, I'll be lucky to have $600,000 left by the time I'm 85. They're essentially clawing back all the tax deferral benefits they promised me for 40 years. I saved $1.2 million. I'm going to end up with less than half of it actually usable. The rest goes to the government. And I'm one of the lucky ones, because I found out now, because Gerald told me now, because I have 6 months to try to do something about it. Most people have no idea this is coming. They're going to get a letter in January 2026 from their IRA custodian explaining their new required distribution amount, and it's going to be triple what they were expecting, and by then it's too late to do anything strategic. Let me tell you why nobody's talking about this, because this is the part that made me angry. Gerald told me he's been to 3 professional conferences in the last 2 months. Conferences for CPAs, for financial advisors, for estate planners. And he says maybe 20% of the professionals in those rooms understand what this law actually does. 20%. The rest either haven't read it because it's buried in 847 pages of dense legislative language, or they skimmed it and didn't catch the implications, or they're waiting for someone else to explain it to them. And here's the other thing. The financial services industry isn't exactly rushing to sound the alarm. You know why? Because they manage your money. They get paid a percentage of assets under management. If you have $1 million in your IRA and they charge 1% annually, that's $10,000 a year to them. If you start pulling that money out early to avoid the tax trap, their fees go down. So there's not exactly an incentive for them to call you up and say, hey, you should probably get your money out of here. I asked Gerald why the government would do this. Why change the rules this dramatically? He said it's simple. Revenue. The federal government is drowning in debt. They need money. And there's $35 trillion sitting in American retirement accounts. Trillion with a T. If they force everyone to accelerate distributions, if they push retirees into higher tax brackets on money they don't need yet, the government collects hundreds of billions in extra tax revenue. It's a cash grab dressed up as fiscal responsibility. And the beautiful part, from their perspective, is that it's not technically a new tax. They're not raising rates. They're just changing the distribution schedule. So it doesn't get the same political blowback that an actual tax increase would get. Gerald showed me the estimates. The Congressional Budget Office projects this provision alone will generate an additional $187 billion in tax revenue over the next decade. That's not money appearing out of nowhere. That's money coming out of retirees' pockets, your pocket. So what do? That's what I asked Gerald. What the hell do I do about this? He said the first thing is don't panic. The second thing is move fast, because the window to act is closing. Here's the timeline. The law takes effect January 1st, 2026. That means the new distribution requirements start then. But the strategies to mitigate it, to work around it, those need to be implemented before the end of 2025. We're in February 2025 right now. That gives us 10 months. 10 months to restructure 40 years of retirement planning. Gerald laid out what he's recommending for me and what he's telling his other clients in similar situations. I'm going to share it with you because you need to hear this. You need to take this to your own CPA or financial advisor and ask them if these strategies make sense for you. Strategy number 1, Roth conversions. Now, this year, as much as you can stomach. A Roth conversion is when you take money from your traditional IRA where it's pre-tax and you convert it to a Roth IRA where it grows tax-free forever. The catch is you have to pay taxes on whatever you convert in the year you convert it. Under normal circumstances, you'd want to do Roth conversions slowly, a little bit each year, staying in lower tax brackets. But we don't have time for slow anymore. If you wait until 2026, you're going to be forced into massive distributions anyway, and you'll pay taxes at the higher rates. Gerald's advice: convert as much as you can in 2025 while staying below the 24% federal bracket. For a married couple, that's up to about $190,000 in taxable income. So if your normal income from Social Security and pensions is $60,000, you could convert up to $130,000 from your IRA to a Roth and pay 22% to 24% on it. Yes, that's a big tax bill this year. But compare that to paying 32% or 35% on forced distribution starting next year. You're essentially choosing to pay taxes now at lower rates on your terms rather than paying higher rates later on the government's terms. And once that money is in a Roth, it's done. No more required distributions ever. It grows tax-free. You can pass it to your kids tax-free. The government never touches it again. Gerald ran the numbers for me. If I convert $400,000 of my $1.2 million to a Roth this year, I'll pay about $88,000 in federal taxes. That's brutal. That's a check I'll have to write. But if I don't do it, and that $400,000 stays in my traditional IRA and gets subjected to the forced distributions, I'll pay over $150,000 in taxes on it over the next 10 years. I save $62,000 by acting now. And the money that stays in the Roth grows tax-free potentially for another 20 years. Strategy number 2, strategic withdrawals to stay below the $500,000 threshold. If you don't want to do a massive Roth conversion, or you can't afford the tax hit all at once, there's another play. The $500,000 threshold that triggers the accelerated distributions that's measured at the end of each year. So if you systematically withdraw money from your IRAs between now and December 2025, keeping your balance just under $500,000, you might be able to avoid the provision entirely. The problem with this strategy is you're taking the money out, paying taxes on it, and then what? You have to put it somewhere. If you just stick it in a regular brokerage account, you'll owe capital gains taxes on any growth. But at least capital gains rates are lower than ordinary income rates. Gerald said some of his clients are using this strategy combined with life insurance. They're taking money out of IRAs, paying the taxes, and then putting the after-tax money into cash value life insurance policies that grow tax-deferred and can be accessed tax-free later through policy loans. It's complicated. It's not for everyone. But the point is, there are moves you can make if you understand what's coming. Strategy number 3, charitable giving through qualified charitable distributions. If you're charitably inclined, if you normally give money to church or charity or nonprofits, there's a way to do that directly from your IRA starting at age 70 and a half. It's called a QCD, qualified charitable distribution. The money goes straight from your IRA to the charity, and it counts toward your required minimum distribution, but it's not included in your taxable income. So you satisfy the distribution requirement without paying taxes on it. Under the new law, if you're being forced to take out $120,000 a year and you were already planning to give $20,000 to charity annually, you could do that $20,000 as a QCD and only pay taxes on the remaining $100,000. It's not a complete solution, but it's a tool. Every dollar you can shield from taxation matters. Now, I know what some of you are thinking. You're thinking this is complicated. This is over my head. I don't have a CPA like Gerald. I don't have anyone to help me navigate this. I understand, and I'm not going to lie to you and say this is easy. It's not easy. The law is deliberately complicated. The strategies require professional help. But here's what I need you to understand. The cost of doing nothing is catastrophic. If you have $500,000 or more in retirement accounts and you do nothing, you are going to lose somewhere between 30% and 50% of that money to unnecessary taxes over the next decade. That's not an exaggeration. That's math. So even if you have to pay a CPA $2,000 to run the numbers and create a plan for you, that $2,000 could save you $200,000. That's a return on investment of 10,000%. If you don't have a CPA, find one. Ask your friends who they use. Google CPA near me specializing in retirement tax planning. Call 3 of them. Tell them about this law. See if they know what you're talking about. If they don't, call someone else. And if you absolutely cannot afford professional help, at minimum, go to the IRS website and educate yourself on Roth conversions and qualified charitable distributions. The information is there. It's dense, but it's there. Because nobody, and I mean nobody, is going to care about your money as much as you do. Let me paint you 2 pictures, 2 versions of the next 10 years. You get to choose which one you live. Picture 1, you do nothing. You assume this video is exaggerating or that it doesn't apply to you or that someone else will fix it. January 2026 comes, you get a letter from Fidelity or Vanguard or wherever your IRA is held. It says your required minimum distribution for 2026 is $95,000. You're shocked. You call them. They explain the new law. You take the distribution. You pay the taxes. 35% of it gone. This happens every year for 10 years. By 2035, your $800,000 IRA is down to $320,000 after taxes and lost growth. You're 81 years old. You're watching your kids struggle financially. You want to help them, but you can't because the government took your money. Picture 2. You act now. You call a CPA this week. You spend March and April running numbers and making a plan. You do a $300,000 Roth conversion in 2025. You pay $66,000 in taxes and it hurts. But that $300,000 is now in a Roth growing tax-free. The remaining $500,000 in your traditional IRA, you manage it carefully. You stay just under thresholds. You use QCDs for charitable giving. You structure things intelligently. By 2035, you still have $750,000 in combined retirement assets. Your kids inherit the Roth tax-free. You've kept $430,000. That picture 1 loss to taxes. Same person, same starting point. Different outcome based on 1 choice, whether you acted or didn't. I'm choosing picture 2. I'm meeting with Gerald again next week to finalize my conversion strategy. It's going to hurt to write that tax check in April 2026. But I've spent 40 years building this nest egg, and I'll be damned if I'm going to let a buried provision in a 547-page bill steal half of it. Here's your homework. I'm serious. Do these 3 things this week. 1. Find out exactly how much you have in all tax-deferred retirement accounts combined. Not just your main IRA, all of them. Old 401ks you forgot about, inherited IRAs, all of it. Add it up. Write down the number. 2. If that number is over $400,000, which means you're getting close to the $500,000 threshold, schedule a meeting with a CPA or financial advisor who specializes in tax planning. Not your buddy who sells insurance, not your nephew who just got his Series 7, a professional. This week. 3. Ask them specifically about this law, about the required minimum distribution acceleration clause, about whether Roth conversions make sense for you. If they don't know what you're talking about, find someone else. I'm not being paid to tell you this. I'm not selling you anything. I'm a 71-year-old retired utility worker who just found out the system he trusted for 40 years has been rigged against him, and I'm angry enough to warn anyone who'll listen. This is your money. You earned it. You saved it. You did everything right. Don't let them claw it back because you didn't know the rules changed. The trap is set. It springs in 10 months, but you still have time to step around it, barely.